Hello and welcome to HCL Tech Boardroom. HCL Tech has come out with a strong set of third quarter earnings. I have the management with me, Mr. Vijay Kumar, the CEO, and Mr. Rahul Singh, who heads BFSI for HCL Tech, are joining me now. Welcome, gentlemen, to NDTV Profit. Mr. Kumar, must congratulate you. The profits have come in at numbers which have exceeded the street estimates. But there is a little bit of disappointment on the revenue guidance being scaled lower to about 10 to 12% versus 12 to 14% for FY17. When you're doing so well on your bottom line, why this caution?
Yeah, so I think it's not been correctly interpreted. We had given a guidance of 12 to 14% on constant currency basis, and that remains.
Okay.
There's no change in guidance. And given that there's only one more quarter, we are saying we are going to be in the midpoint of the 12 to 14% guided range. So
where is the 10 to 12% coming from?
10 to 12% is the overall guided range. And in addition to that, we have done a few acquisitions and IP partnerships in the last 2 quarters. So that can potentially contribute another 1% growth.
So let me get this right. As far as I understand, it said when you started the year, in constant currency, you said we are looking at revenue growth between 12 to 14%.
That's right.
Now you're maintaining the 12 to 14%, or is it 10 to 12% in constant currency?
No, constant currency continues to be 12 to 14%. And given that there's only one more quarter, we are saying we'll be in the midpoint of that guided range.
And dollar revenue growth, what is the guidance for FY17?
Yes. So so if you take the December end currency, it's 10 to 12%.
Okay, so you're maintaining that.
Yeah, we are maintaining the guidance.
Right. So
and we are becoming more precise by saying we'll be in the midpoint of the guidance, given that there's one more quarter.
All right. So what was the total billing that you did in the third quarter? Are you maintaining your $1 billion per quarter run rate?
That's in terms of booking, right? So we've stopped giving the TCV booking on a quarter-to-quarter basis because it kind of creates a lot of confusion on whether it translates to revenue or not and things like that. And that's the reason now we're giving much more precise revenue guidance, which will help everyone to kind of put a model and expect what to expect.
But you know, the third quarter is a seasonally weak quarter for HCL Tech. How did it transpire? What kind of growth did you see? Because you are maintaining your guidance for the entire year when other larger players are sounding very cautious. So what have you seen when it comes to the demand environment? What have you seen in the third quarter?
Yeah, our third quarter has been a good performance. We performed very well in line with our expectations. 3% constant currency revenue growth. There was a 170 basis point impact due to Forex. So from a dollar perspective, it's a 1.3% quarter-on-quarter growth. The growth came in, what is unique, what is good about the growth this time is all the service lines have grown. Like infrastructure has grown 2.1%. Our application service line led by digital has grown 2%. Our engineering and R&D services has grown 7%. Our BPO business has grown 2.6%. All service lines are growing. We've done fairly well in US and in Europe. And if you look at the verticals, financial services, manufacturing and public services have shown very good quarter-on-quarter growths. A couple of other verticals are a little soft, but if you look at the year-on-year growths, they're pretty impressive. So it's really a broad-based growth this quarter. And if you look at our the top 5, top 10, top 20 clients, all of them have grown faster than our company average. And our outcome-based or managed services contracts have grown from 61% approximately to 63%, which is again a good validation of our outcome-based business model.
Right. Your profits have come in better than expected. So what has driven these, the healthier bottom line? And you're sticking to your EBIT margin guidance, which is 19.5% to 20.5% for the entire year. Going ahead, will you maintain this? Is there a scope of improvement? Or is there any worry on the margin because you've had acquisitions, the Volvo business, Geometric? Can you give us a little look ahead on the margins?
Yeah, first is I'll talk about this quarter. I think the last quarter we came up with 20.4% is our EBIT range, which is 30 basis points higher than the previous quarter. While there was a wage hike impact and a little bit of impact due to utilization, there are a couple of other factors which has really helped us improve our margins. One of them is, again, impact of automation. While it was extensively deployed in a lot of infrastructure engagements, now we are consistently deploying them in our application services and in the BPO contracts. which is also helping us improve the margins on those contracts. That's number one. Second is, because of the balanced growth, our software revenue has also grown significantly in this quarter, which is usually comes at a higher margin. So I think because of the growth mix is a little bit skewed towards software, most of our growth has come from the software business this quarter. So that's also helping us improve the margins.
Mr. Singh, what was the performance of the financial services? I see a growth of 4.5% on a sequential basis. So where is the demand coming from? Because we have heard even the BFSI space, some large companies saying that clients are cautious about spending in North America. What have you seen in the third quarter?
So it's to do with our model, So in financial services, we tend to focus on the large financial services firms, essentially the Fortune 500 companies. Our companies tend to be global, so they are equally present in Europe, North America, Asia. So that's a mix. So same customer will be present in multiple geographies. So if you look at financial services overall, on an overall basis, they are extremely dependent on technology for efficiency, technology for new customer acquisition, technology for internal risk and compliance, etc. They do. Now, therefore, the spend that is there for financial services customers is not changing in technology terms, right? What is changing is the mix of the spend. Right, so our financial firms spending more money on legacy technology, we see that spend coming down. That's coming down. At the same time, our customers are spending more money on their digital programs, on their transformational programs, on their desire to meet the needs of the millennial population, because a lot of new people coming to the banking fold, etc. So they have different desires and needs, etc. So long as you are able to remix your portfolio with the customer. And so long as you're able to have a good relationship with your customer, and you can do mining, you can move up and down different service lines, you should be okay. Now, where you get stuck is if you are in a single service line, and if that service line tends to be on the legacy side, that could be the reason why commentary is muted. But if you're able to reorient your portfolio, and this is what we are doing, we have this mode 1, 2, 3 strategy, which CVK speaks about. And so long as we are able to scale up the mode 2, which is all around digital and digital technologies, then you are able to change that into account. The other thing that makes a lot of difference in financial services is that the spend pockets are moving from the CIO organization to the lines of business. Now, this is called shadow IT, and therefore it requires that your model of engagement with the customer should be such that you can move up and down the organization. You should be able to go and meet people who are having the new budgets versus people who have the older budgets. So again, the way you interact with the customer, the way you organize your relationship teams, the connects that you have there, and plus the service line that you've got is what makes the difference. Now, in our model, we are seeing, therefore existing customers, are increasing shares with us. So we are seeing, as CVK mentioned, our large clients continue to spend, equal and perhaps a little bit more with us. But more importantly, we are also seeing some new customer acquisitions. And again, in our model, we are really talking about like 1 or 2 acquisitions per every 4 to 6 months, because we don't want to have many customers. We want to have few customers but have deeper relationships. So we've had one win this quarter. We had another win last quarter. New customers acquired. So hopefully that should do well for us in the future as well.
Right. So what kind of deal wins do new customers bring in? And you spoke about mining your existing clients. How much? What does that mean in terms of revenues versus the new clients added?
Right. So the new clients, at least in our case, we've had one which is a traditional, legacy kind of customer win. So, the customers looking for replacing the existing vendors. The traditional model of outsourcing has been more T&M based, which is more people-based models, taking advantage of labor cost arbitrage. That's a traditional model. Yes. Again, in the traditional model, if you can reinvent, use more automation, use more, what is called as elimination of work principles, So that's how you win in the traditional model. We've had one win in the last 6 months in that framework, and then we've had one digital win. A digital win is all about scaling up digital. See, digital is now moving out from labs and POCs to real. The financial service institutions have to compete with fintech firms. They have to compete with disruptors in the marketplace. So therefore, there's what we call a digital to scale.
So how are the deal sizes different?
Yeah. So deal
between
sizes.
My existing clients and newer clients.
Right. So, the deal sizes will be smaller, okay, because the deal size starts becoming smaller as you do digital projects. But there is an annuity component there because there's a lot of repeat small deals that will keep happening because the work involved is huge. If you look at the core digital technology which the customers have to evolve to, there is a lot of work to be done. Yes, the sizes of each contract will be small, but then you will have many small contracts that will aggregate.
Right, Mr. Kumar, when it comes to the IS business, it's very commoditized. But HCL Tech, somehow has not seen a big pressure on the margins coming in. What is it that is working for you in IMS? How did that vertical do in the third quarter? And what's the pipeline? Because there's a lot coming up for rebid. Yeah. So what is HCL Tech looking at, say, in the next 6 months? Yeah.
So infrastructure business grew 2.1% quarter on quarter. On a YOY basis, 28.3%, which is a very impressive growth. And on an LTM basis, it's 24.6. So we continue to grow at a healthy rate in infrastructure business. And what is really helping us, while there is some components of infrastructure business which is getting commoditized, a lot of customers are focused on building what is called as new digital foundation, where they really are building software-defined infrastructure, footprints. A lot of hybrid cloud adoption is happening. Some component of infrastructure is moving to public cloud. And there is a significant amount of focus in cyber security, and there is a lot of spend around cyber security. The workplace is being reimagined to what we are calling it as digital workplace, with millennials, with a lot of expectations of the experience that the employees are expecting in the workplace. That's also resulting in a lot of digital transformation projects. All of these are helping us to grow in the core infrastructure, the foundation layers. The second element is there is still a good rebid market. As long as you are differentiated, your propositions are resonates very well with the customers. We continue to win a significant amount of rebid bids that we bid for.
What would the pipeline be in the rebid market for the next 6 months?
So I wouldn't want to comment on our own pipeline, but if you look at the overall rebid market, it's $140 billion in the next 3 to 4 years. And maybe half of them will change hands. That's the expectation. So I think there is a lot of scope for us to grow in our core services.
What about the engineering and R&D business? It's done really well this quarter, up 7% sequentially. Right. Yeah. So what worked for you? New clients, new platforms, new offerings? What's in the strong growth?
So here again, as technology is becoming core to a lot of enterprises, the technology companies are also looking at how can they provide innovative solutions, and that's one thing which is driving some of the growth in our engineering services. The second thing which has helped us grow is also the revenues from the IP partnership. That's also a part of our engineering and R&D services revenue. I think both this put together is helping us, and this has been a very impressive quarter for our engineering services, with the 7.1% quarter-on-quarter growth.
So when it comes to the geometric acquisition, and you spoke about the IP business with IBM, how much more will these add to your top line, and is there any concern on the margins because of these two?
So one is all these acquisitions and the IP deal will contribute 0.6 to 1% additional growth in addition to the guided range that we have provided. That's number one. Second is we're also clearly stating that our margins will remain in the guided range in this quarter as well. While the full year is 19.5 to 20.5, we're also clearly guiding that even in this quarter, which is January, February, March, the margins will be in the 19.5 to 20.5 after considering the acquisitions.
Right. When it comes to the worries about visa cost escalating, is HCL Tech a better place given your offshore on-site mix?
Yes, we are definitely better placed. If you see, traditionally we have focused on building a lot more local global delivery footprint. We have 6 large centers in the US, and we have extensively focused on increasing the local hiring over the last several years. This is one reason why our visa dependence is significantly lower. And if there are some more tighter regulations, and we can react to it much faster. We are increasing our local hiring engine as well. So all that will help us to further reduce the dependence on visas.
All right, Mr. Kumar, Mr. Singh, thank you so much for speaking with us at NDTV Profit.
Thank you.
Thank you.
I have with me now Mr. Karan Puri, who heads consumer business and the commercial industries business in HCL Tech. Thank you so much, Mr. Puri, for joining us on NDTV Profit. Now, I'm looking at the verticals, and sequentially, I've seen pretty strong performance coming in to manufacturing. Now, the third quarter is seasonally quite weak, especially for manufacturing, given the off days in North America and the rest of the world. What has led to this strong performance in the manufacturing segment?
So if you look at largely the markets that we are focused on is North America and Europe, which is the bulk of our revenues. The traditional model has always been an industry which are very consumer focused, which are typically geared to manage what we call the high season in these industries, retail, CPG, and some of the other verticals. They effectively deliver all their projects way before the peak season starts.
Okay.
So third quarter, which is effectively the O&D quarter, is usually a weaker quarter. Manufacturing has a slightly different model because they are effectively providing for the financial year that is coming following that. So a lot of project work gets polarized into the third quarter, the fourth quarter, but that's when they gear up for the next fiscal. Also, there's also a combination of projects that tend to taper off for the same reasons. So it's not uncommon to see some of these industries weakening in the third quarter, which is the O&D quarter, and some of the non-traditional industries, manufacturing being one of them, actually start investing a lot more for the next fiscal.
But their, performance in the retail segment has been weak compared to the previous quarter, down about 7%. Is this a seasonal thing, or were there any client-specific issues?
So let's just see the way retail is investing. It's investing in consumer-focused activity, a lot of digital work. What they don't want to do is to change stuff when the peak season is happening, which is their high season, which is typically Thanksgiving through to Christmas. Most projects finish before that. So the third quarter, which we just finished, effectively is a weak quarter insofar as projects that are to be delivered are concerned. Secondly, if you look at the overall annual performance, it's actually pretty healthy. It's clearly beating the industry by far. On an annual basis, we are talking of the vertical that have grown very fast have grown in the 20s year on year.
That
even larger verticals are in the 10 to 15% year-on-year growth.
So we see on an annualized basis, public services, retail seeing growth in excess of 20%. So what's working for HCL Tech here? Is it the offerings to the clients, existing clients, were you able to mine them for more? Or are you adding new clients? Where are you seeing good traction when it comes to new clients?
So this year, particularly since you talked about new clients, we've had an extremely good year. I think this year we've gone up from the usual 4% net new billing to over 6% net new billing. So as a percentage of total revenue, it's definitely gone up almost 50% over last fiscal. So new client acquisition has become a big strength for us. Also, we've oriented our business model to focus on new business acquisition, new client acquisition. Having said that, even existing customers with a fair amount of investments are being put into digital work. There's a very high velocity. So the industry that have traditionally having impact on the business side have started investing a lot more on the change projects, which is digital projects. Utilities, for example, oil and gas, they've been struggling for a while. Those industries also started investing a whole lot more than ever in the past on new project work on digital. And we've had a sweet spot around that also. So I think that's where a lot of this growth has been evident to us.
Can you tell us what were the new client additions across these verticals that you managed the third quarter?
I think the number would be in excess of a score about 20 plus.
20 plus.
But the interesting thing, and which I think CVK also alluded to, is about 9 big projects have come through on change projects. And the shift that you will find HCL focused on is what we call the digital middle. Because a bulk of the work that a lot of companies are doing slightly are on the front end or on the user interface in some of the areas which are more project focused. What we are focused on is almost engineering or re-engineering the platforms for these companies and industries. So the broad digital middle is where a lot more big projects have started rolling in. And that's become a growth driver for us as well.
So what is the outlook like for what is now changing when all the companies are looking at the digital things of way of doing business? Where are your offerings very strong? Is it the front-end consumer business? Is it the transformational business? Is it a combination of both? What's going to work for HCL Tech going ahead?
So if you look at HCL's legacy, it's largely been engineering. We've been essentially an engineering company. The DNA is core engineering. What we've done exceedingly well by virtue of that is actually engineering of platforms. We've got history of maybe 30-35 years of pure play engineering of large scale platform that drive industries, and these are across high-tech companies, pharmaceutical, medical devices, aeronautics, avionics. All of this is now coming to bear because fundamentally what we've done is just figure out what it takes to run a platform over multiple years. The big shift that is now evident on digital is ultimately wanting companies to rebuild their digital core. And enabling that has become a sweet spot for us just because of our engineering heritage, which frankly a lot of companies can't typically even claim. The other component of our growth has been infrastructure. You cannot do digital at scale unless your infrastructure is able to support, sustain, looking at how you can marry that to the cloud, public and private. I think those are the two big elements of enablement that we have, clearly as an advantage, more a DNA of HCL than only capability.
But going ahead, which verticals do you see more traction for growth, more business coming your way? Any particular verticals doing better than the others?
I would think the bigger verticals clearly would continue to grow in the current trend line, which is between 10 to 15%. So I don't think the customer acquisition or customer growth is going to be a challenge there. And those are really how growth will continue to sustain in the same guidance that we have provided for this year as well. The smaller verticals are clearly growing faster.
And these smaller
those
verticals?
Are obviously the public services. Clearly has been a 20% plus driver for us.
Right.
Healthcare is definitely a new one, new growth engine for us.
And
life science has always been a growth engine for us. It's basically these areas that have grown well.
And these offerings again from HCL Tech include the commoditized business plus the digital services. Is that the focus, or is it basically on the digital services?
Digital is what we call the broad digital is frankly the big growth engine for us. Not to say core business, the rebid market is not going away. It is staying there. The interesting thing is just because the nature of change that we are anticipating, the funding has to come from the run side of the house. And that funding, by virtue of its being shrinking, is giving us a lot more leeway to invest in projects on digital as well. So I would think it will be a balancing of portfolios, not a reduction of portfolios. And frankly, customer spend is almost supporting that thinking as well. It's flat, marginally better, and depending on the industry or company, which means the dollar is not going away.
All right. Is there any caution on the business coming in from North America, given the new regime change? What is being said about hiring locally? Any worries there for the new business coming in from US?
See, the fact of the matter is companies will reinvent themselves. Industries will reinvent. The more that we hear about issues of bringing jobs back, essentially means a higher cost to deliver, which means that cost increase will have to get offset from new projects, digital projects, different kind of projects. To me, the dollar spend is not going to reduce by any measure. So the revenue side clearly will not get impacted. What we have to see is how we essentially enabling the change for the customer, because he doesn't have extra dollars to invest in that change. So I think that's where the broad digital strategy that we laid out is clearly proving to be a good advantage. The second dimension, which is very important for us to understand, is that the more customers insist on getting their jobs back, the more they're effectively trying to say that I have more resources to deploy, but the dollar remains the same. That efficiency component becomes very high. So the fact that we bring engineering to the fore, I think will also help us become even more core to that change. Traditional companies that are focused on time and material will have a problem. Companies that are focused on bringing a lot of H1 visa employees will have a problem. I think on both those counts, we are better placed than almost anybody else in the industry.
So in this quarter, was the productivity higher? Revenue per employee, was it better?
For sure. It's a number that we're tracking very, very carefully. To the point CVK made earlier as well, I think the percentage that we are focused on in terms of effort reduced is largely because of automation and AI. And it's effort reduced. It's not about headcount really. It's about what does it take to deliver the same quantum of work, and what reduced metric or what's the additional metric that you can save on that account.
And how much do you think in terms of margins could there be a saving because of automation? Can you quantify it?
So the way we kind of measure this is effectively we put a metric which effectively goes across different service lines differently. Infrastructure, for example, process automation, which is almost a big component of that. BPO, again the same guideline. The percentage is much higher in terms of savings, because the tooling allows you to have a very different connotation. When you look at fixing issues, when you look at doing code development or generating code, there's a different metric altogether. So when you look at the business, it's a very different metric based on the either engagement that we have or the service line. But the fact of the matter is every account is being tracked for the service being delivered in that account by virtue of saying what's the effort reduction.
Okay.
And that's clearly been a big metric for us internally for the last several quarters now.
All right, Mr. Puri, thank you so much for speaking
Thank
with
you
us
so
at NDTV Profit.
Thank you. Yeah.